Assalamu alaikum, everyone. Welcome to another session of the Entrepreneur in Conversation series at the National Incubation Center here at LUMS. Today, we have the pleasure of the company of two of our Foundation Council members, Ali Mukhtar, founder and general partner, Fatima Gobi Ventures, and Faisal Aftab, managing partner, Lakson Venture Capital. Ali is a graduate from the University of Pennsylvania, and his venture capital fund was established in 2014 with the vision to support the startup ecosystem of Pakistan. Fatima Gobi Ventures has invested in leading technology startups, including Airlift, Tajir, SafePay, and Sasta Ticket. Faisal took his MBA degree from Oxford University. Lakson Venture Capital is a pre-Series A institutional VC fund backed by the Lakson Group and other leading local business families. It is focused on Pakistan-based opportunities where technology can be leveraged to enable, enhance, and disrupt existing business models and create new ones. Today's discussion is essentially between two investors who have invested in more than 15 ventures in Pakistan. They will highlight investor expectations at angel and seed levels. This will also be an excellent opportunity for venture founders and investors to engage and glean crucial insights for successful capital raising strategies. Welcome, Ali and Faisal, and let's begin our conversation. Really looking forward to this conversation today. We have in our audience our cohorts from Lahore and Quetta, and the general audience through our Facebook Live.
Thank you. Thank you so much. Ali,
Thank
good
you,
to see you as always.
No, great. So Faisal and I, have been in the ecosystem from very early days. He's seen the evolution, and then we've sort of have had multiple discussions. So glad to be here with NIC. And then looking forward to the conversation, as well as the questions that the startups may have.
Likewise, I mean, from Ali and I, Ali is one of those guys that I pick up the phone and always call in the ecosystem because he's been active a lot longer than I have. I entered the ecosystem at least, I think, a couple of years. I'd say almost 4 years after you did, Ali. I think you were investing as an angel since 2014, I believe, in Pakistan. So it's as the ecosystem evolves, it's very important for venture capital funds to share knowledge with each other and discuss and share thought processes. So it's been it's a pleasure to be actually on the same stage with them, having the candid discussion that we always do in private, anyways.
Yeah.
So I guess starting off, Ali, maybe we can talk a little bit about what startups typically are thinking of, how to approach investors. Why don't you give your insight on how somebody should approach Fatima Gobi, and then I'll share some of my insights accordingly as well.
Sure. So I think overall, when startups are thinking of raising for their, seed rounds, Series A rounds, they need to understand, when is the best time to be raising capital. So once, and then we can, over the course of this conversation, discuss that. So once they have done that, I think the next step is to then understand, okay, within the venture ecosystem, both locally as well as, in other markets, what VC would be the best fit for their startup, right? So in that, different VCs have had, most of them would publish their portfolio, on their website. There will be fundraising news, etc. So you can understand, what kind of investments are they making. So once you've applied that filter, and then you think, Fatima Gobi Ventures is also the right fit, then we do receive a lot of applications. We have a wide mandate looking at multiple sectors. And you can reach us directly by email, LinkedIn, through the network. That network could be our portfolio companies, that could be co-investors, that could be multiple other people, and then based on that, we review applications. We maybe saw 400 or 500 applications, but we met with 100 plus founders last year, and then ended up making 5 investments. So I'll stop there and see. So once I think we receive the applications, we have our review meetings. Based on that, we sort of move the conversation, and then over the course, if the conversation's moving, we take it to our investment committee, etc.
I think what you mentioned for specifically for same thing happens to me, where we get contacted by startups from effectively all mediums out there, right? So somebody would get a hold of our WhatsApp, email, the general addresses, both individual WhatsApp emails or LinkedIn, and it's very inundating at times because everybody has an idea. And I think what's best for a startup is to effectively, in order to get traction with a fund, I would always suggest is understanding the life cycle of a company, of a startup's life cycle where a fund invests. So for example, if a fund is early stage, and they do seed investments or pre-seed investments, then they're probably the best fund to contact. And most of this data is usually on the website when you go to these fund websites. So for example, I'll get contacted many times by startups that are in the Series B stage of their life, which our fund does not do because we're a pre-Series A fund. So just knowing the right fit. Something else that I always say is that if we've invested in a competitor of yours, more than likely we probably won't invest in you, just because there's usually, although there's ways to parse it out, but typically if we're supporting a company, we don't want to support competitors. So that's something to take a look as well, both for domestic and international funds, where that should be a barometer, I think, for a startup in terms of when you're looking for the right fit from a VC firm. But generally, I feel like our ecosystem is so young that that most of us, at least today, there's a total of only about 5 funds in Pakistan that are active on a full-time basis, and the rest are angels and smaller micro funds as well. So I think it's important at this stage that most of the funds I think sit in the early stage segment anyways, which is where I think most of the startups exist in Pakistan. Ali, in terms of how the angel ecosystem, I mean, what would your advice to be to startups that effectively have never raised any money, and should they go for a friends and family round? And you were an angel at one time yourself, so if you could share some of your knowledge there in terms of how startups should be going about.
Yeah. So I think Faisal, you raise a very important point, and the point also is to do with the life cycle, and the evolution of startup, and in that journey, where you are, understanding that is important. And then I think usually the first round of funding, it can vary, but typically what we've seen in Pakistan is, and in a lot of other markets, is that when you're sort of pre-launch, pre-MVP stage, that's where friends and family, angels in the network are the best source of funding. They can give you the initial capital to go out in the market, to validate some of the questions that the business and the relevant solutions for that. And then based on those, you can really think what the next best source of funding is. It could be a seed capital, it could be Series A capital. So understanding where you are versus what the right investor set is. In some cases where if you're doing first principles kind of research, in a lot of markets you will have strategic industry players as well as government that may fund that research, because VCs generally, when they're coming in, the time to market for the company really matters, right? So if it's a very research-based project that may come into the market in a long time, Perhaps, there are other sources, such as Ignite in Pakistan and strategic corporates. So that's where I would say, although, when we started, even the angel network in Pakistan back in 2014-15 was still, it was very hard. But from then to now, a lot more people are interested in the space. Every day, more and more angels, a lot of angels have been formed through the Kareem exit, and multiple other traditional industries, where people have made money. They're now looking to diversify into startups. So the ecosystem is getting healthier in terms of sources of funding.
Yeah. And you brought up a great point in terms of whether a startup is ready for a VC fund, and especially in the early stage with the friends and family rounds. At that point, what you also have to, I think, go and look at is your startup really one of those startups that fits a VC fund from an exit point of view? Because some businesses are lifestyle businesses where it's a great business where you set the startup up and you may not ever want to exit or sell it to someone else. So in that scenario, you're probably better off raising from private parties. Funds typically we're driven by mandates where we have to basically go and invest and then make money by selling these companies eventually for people. So I think that's a very that's important consideration because I do get approached by a lot of effectively early stage ideas where the individual doesn't really have any desire to sell the company at an exit many years down the line, and that alignment is also extremely important. One of the other things I feel is that, and Ali, I'd like you to comment on this as well. I'll share some of my experiences. I feel like investing in companies is more of an art versus a science. Every investor has individual metrics that they look at. I'm always known in the market for doing excessive due diligence, where I can take too long at times, just trying to cross my T's and dot my I's. But what are some of your metrics that you look for in terms of what's your approach in the market, especially when you're looking at really early stage companies that a lot of the cohort that's going to be entering the NIC?
Yeah, I think early on and even through subsequent rounds, it is what we're trying to do is build conviction around the founder primarily. Whatever they're dreaming about or trying to envision, whether they can get to that and they have the execution capability that we try to assess through multiple factors, including whether around their vision they've been able to get co-founders that have bought into that dream, the key hires, initial people who are joining the team. So these are all important signals. And then later on, the overall, if the startup, I guess you would hear this quite often is, instead of what if this startup fails versus what if this startup makes it, then what happens at that stage. So trying to understand, wrap our head around that for us is really, really important. But I would love to understand more, on the due diligence part that Lakson looks at, because that is also very important.
So I can talk about from my two stages in life, when I was an angel investor abroad versus institutional needs. So obviously the pressure, the burden and the fiduciary responsibility is much higher when you do it in a fund format, because you have to cross your T's and dot your I's. So typically, what I look for when I see a startup, apart from your traditional financial, operational, technology due diligence, which all of us do, is I really, it comes down to the people. And especially in the pre-series A and seed stage, if the team, metrics we look for is, what have they done in the past, where we could look for some sort of an example of their potential to succeed. How much have they thought through the idea? and do they have the tenacity to succeed? The reason why I say that is that I do feel that at least 20% of the people that I'm seeing with decks out there that are entering the startup space seem to be entering it because it's a fad, and they may not have the conviction to stick around long enough. In my opinion, entrepreneurship is probably the toughest endeavor you can take on, and there's lots of trials and tribulations before these successful companies pop up. A lot of these successes look very easy, but you can go and talk to any of these founders, whether it's Munib or Usman Gul or Fazan, and you'll see that a lot of times they have bags under their eyes because they're up all night trying to make sure that the system and platform is up and running. It's a constant battle. So those are some of the signs I look for: is the tenacity of the team, how well balanced the team is it dependent on a single founder, or is the entire team capable? Because you do see a lot of co-founders slapped onto decks, and it turns out that really it's just one person. So what is their cohesiveness level? In some scenarios, I've looked at companies where the team was together in some other business before, and then they've decided to enter this business. So that can be a sign where you can get the dynamics. But I mean, really, it comes down to these, I would say, qualitative figures versus quantitative, especially in that early stage. When you enter that pre-Series A stage, I think things change because we start to see basically a minimum viable product that's already in the market. You're seeing early signs of a product market fit, a month-on-month revenue growth, or a network effect. I think at that point, it becomes a lot easier because we can turn back and look at the historical performance, whether it's 6 months, 1 year, 2 years, or 3 years. I don't think it's going to be 3 years anymore in Pakistan. We had this ability 2-3 years ago. Now things are moving very fast. But looking at some sort of historical monthly patterns or quarterly patterns and trying to predict based on that how the team is performing. It ultimately, again, boils down to the team. And then how the startup is growing is actually the cohesiveness of the team and how they were able to execute. So those metrics are key. Then we have to do your traditional stuff, which is go in and develop those models. What I like to do is I like to stress test the financial models. And really what it comes down to is very simple stuff. You're getting money. What is your operational expense? What is your burn? What are your key metrics, and how will you sustain this? And then we try to imagine and visualize, which is usually always wrong because it's just nothing more than assumptions. But we try to predict, okay, what type of money will be available in Pakistan, let's say in a year from now, or 2 years from now, and do you need to come back for funding that quickly? So it's just trying to weigh out these things and look. These are fairly cookie cutter, I think, things that most VCs do. But I still feel like it's an art versus a science, because as individuals and as investors, we all have our own unique, way of investing. And I think that also comes into play when people approach venture capital funds.
I think Faisal, you raised an important point earlier, which was, lifestyle business versus, a business that you're going to raise money from venture capital, right? So if you could, talk a bit more into, what the differences are, I think for people that may be, very, very beneficial.
So a lifestyle business is, for example, I got approached by someone about 6 months ago, where they basically wanted to build. It was essentially a fast food restaurant, right? Even though it's not, we're tech. I still entertained it because every now and then we have the opportunistic 10% where we can invest in a non-tech. When I asked the founder, when you look at the numbers are great for someone that is drawing a big salary from it and living a lifestyle from that business. But as an investor, we don't want it to turn into that. We're expecting, we were putting in the money, and the next day the founder has a Mercedes and is living in a nice house, and the money's not going towards growth. So those are some of the metrics that, even though the idea is good and probably the business is functional, it is something that the person is looking for more of a lifestyle business versus an actual business. They want to put all the money back in to keep growing it. Typically, the founders that want to keep doing that are the ones that are also looking to just exit, right? So versus taking the dividend upfront, in what lifestyle businesses happens, you're effectively delaying the gratification or dividend till an exit. So your vision is to grow this company to 100 million, 200 million. And that sacrifice is the key differential, I think, in terms of what a VC fund is looking for.
Yeah.
So, for example, like if somebody has approached us and with an idea and they're looking for $1 million, and then I see a salary in there for the person for 20 lakh rupees a month, that probably is a good sign that this person is not going to be able to focus. Their skin in the game is not significant enough when it comes to drawing the big checks. I mean, ideally, a founder that has significant equity should be drawing a sustainable salary. I'm not saying to, basically they shouldn't be worried about their kitchen expense,
Yeah.
but it shouldn't be a luxury salary. So these are some things to consider that, the alignment, I think, has to be there. And when that alignment is not there, is when I feel that effectively when the investor and the team or the founders are not aligned, I think that's where sometimes problems have emerged. I mean, as you see in other markets, luckily that hasn't happened in Pakistan to any of us yet, I think. But that's what I primarily meant by that. The exit was the key component, right? That
yeah, and I think the other important factor, in terms of then going to raise from a venture capital is also the return expectations, right? Typically, on a very, very high level, if let's say you have a $10 million fund, and that has to return investor capital back to the LPs that are investors in the fund. So the 10 million fund, typically it's a 10-year life cycle fund. And if, it has to exit at least, 10x range for it to, give the desired returns back to the investors, right? And if you then play that down into your portfolio companies where, let's say, you're holding a 10% stake per company that has to dilute over time. So if you're raising, let's say, at a valuation of $1 million, you have to build a business in that time that exits at $10 million plus, right? And if you're raising at 10 million, that means you have to exit at least 100 million plus, right? So and that ties into, why if VCs look for high growth business models and are trying to fund companies that have those network effects and that can grow really, really fast.
Absolutely, that's extremely important. I think maybe we should talk a little bit about the cohort that's coming in and what I guess you and I are looking for in terms of to identify and value add. I mean, I can speak from my personal perspective is that, at this stage depends on the type of companies that are joining, at least what I've seen at the other NICs. I'm seeing the spectrum across the board. So some are seasoned. And Ali, this is a mutual question. I guess it's a question to you, joint response. Sometimes I'm seeing companies that are just coming to the NIC for the sake of effectively learning and growing their marketing. And they're not actually looking to raise money, which is actually a positive thing in the sense that the seasoned teams recognize that, hey, maybe we're really strong on tech, but we don't seem to know the marketing side of things. So we're not that strong on the financial side of things. So they're looking to pick up some of those skills. And at other times I've seen companies that are just very young teams and they're looking just to learn the entire, effectively learn the difference of some of the stuff you and I just spoke about in terms of a venture startup ready for venture capital funding eventually, or is it a lifestyle business? Because these type of metrics I'm seeing as well, at least in some of the other places. So what is it that you're looking for in the cohort that's coming to the NIC?
Yeah, I think, when we were sort of looking at the NIC, so I've been involved early on since I think 2017, December 2018. And from then to now, NIC has also evolved. And then the idea has been to look at essentially key sectors in the economy in Pakistan, right, which is fintech, edtech, sustainable ventures, and then it's agri-tech, right? So some of these verticals are important for NIC Lahore, where I think they're now being more focused. And then in terms of I think startups that are incoming startups, I think in the early days, because it's an early stage model where you have an incubator and you have an accelerator, and then the majority of companies in those two also differs. But if you're applying to the incubator, right, it's in most cases, it'll be startups with their ideas and some early team members, co-founders that are with them. That will apply. Typically it will be 400 to 500 applications. Typically, 30, 40 of those will be selected into the cohort. And in that process, I think, and you're Faisal actively involved in that as well. So what we're collectively looking at is, if these teams have the capability to execute on their vision, and then through the incubation program, then different areas of their businesses are identified, and then it's a collaborative process where at the time they're graduating, they have their proof of concepts, they have validation in the market, and then they are ready to maybe raise angel and seed capital at the commencement of the program.
Yeah.
So that's I think where NIC is now focused on creating a lot of value, then bringing in industry partners, investors, and then different stakeholders together.
It's and what I feel is, I think I guess advice to those applicants that are coming in, and you can probably shed some light on this too. What I see sometimes is, especially in the application phase, just because there's so many more companies that are coming in, is really one of the key defining factors for me, at least, is the total addressable market that has the startup really thought through that component. Sometimes I feel like that's missing, where effectively people are coming in, not to discourage people, but like there'll be the idea, the total addressable market will be like 50 billion, and they're going out to conquer the world. I personally feel that Pakistan is such a big population, as the fifth most populous country, that if the idea can capture Pakistan, I think that's a good enough idea to begin with. And then obviously regional expansion makes sense, and then having a step-by-step plan. But many times I get really scared when I see that they're going to be selling in the US within 2 months of launch, which is probably, as you and I both know, is one of the most competitive markets. Not to discourage innovation, but I still think that there's so many local use cases and gaps. What are your thoughts on that?
No, I think, and especially now you're seeing models that are evolving, in emerging countries that you have not seen in, more developed countries, right? Because these are exactly to your point, localized solutions that are relevant for the domestic market, right? You're seeing a lot of that happen in the SME space, even in the consumer space, where companies are localizing their products and then are doing really, really well. So that's definitely the case. I think the market, and then I think that we can come to next is the investment landscape of Pakistan. But I think that's why now you're seeing this increasing interest in the VC space, is because there's a large addressable local market, 220 million people that are increasingly, becoming online consumers. Their habits are shifting, accelerating in the last, year. So all of those things are now attracting capital to fund ideas that can serve the local market. And then, beyond that, if they do scale outside, then that's really good. But you can build sizable, large businesses in Pakistan, which a few years ago may not have been possible. I think the year I made my first angel investment, we had about 25 million internet users, and now I think we must be crossing 90 million users.
Exactly.
Right. So huge.
Fourth fastest growing country in the world for broadband adoption is what I keep hearing. Although we need to validate that from somewhere. It's well, the number is 750,000 new users coming online each month. Sometimes I've heard like 1 million users, right? But we're seeing that. I mean, all of us are seeing that, both you and I in our portfolio companies, where the demand, the scalability is massive. I mean, it's just month-on-month growth is truly. I remember when I first got into it, and the metrics that people would define as key metrics of looking at month-on-month growth of 20%, 25% in these frontier markets. I was like, how is that going to even happen? And now it's surreal to see it happening in front of you, where all these companies are growing at that pace. So interesting opportunity. Ali, and this is one of the things I always say, that anybody that's launching something today, instead of looking back, looking at where the market is. Similar to what you said, I mean, what I felt is that we had this anomaly in Pakistan, where 3G and 4G effectively were launched so late in Pakistan compared to India and MENA and the Southeast Asia region, that which were the main catalysts for smartphone adoption, right? Where data was available to the general mass population. And it was effectively, when we would compare dollar to dollar in terms of in our ecosystem, like the amount of money being invested in India or Indonesia or Middle East. I really feel we have that 5-year lag effect because of that late 3G and 4G launch, which ended up happening in 2014 and 15. And the results of that we can all see now, where the valuations are increasing. And that lag effect, I think, is diminishing as well. So the funding, I think, quantum for a lot of these new cohort, new cohort that's entering the NIC, I think it's going to be a lot greater than it has been in the past, because I think when you entered the space in 2014 in Pakistan, there's probably you and a handful of other angels. Today, I'm seeing like every other day, every family group, every high net worth individual wants tech exposure. Are you seeing the same thing on your front as well?
Yes, it's actually changing. And one interesting fact, when we made investments in 2015 to 2016, some of those companies were doing well. And when they, went into the market, there was, even though their metrics were growing on all fronts, but when they entered the market, you did not have a well-established ecosystem of investors, both locally as well as international investors. And interestingly, in the last 1 year, all of those companies have raised follow-on, right? So I think that's important, and then I think now for the incoming batch, it's probably the best time it has ever been, because it was much more difficult back in 2014, 2015. Even though we have a long way to go, but it's becoming more founder friendly, more capital available. People on the investor side are also have a lot more information and know how to make some of these investments. So that know-how is also increasing, right? So but still, I think we have a lot more work to do, Faisal.
Absolutely. I think it's in our business, the work never stops.
Yeah.
It's Friday. Both Ali and I are taking time, I think, after a very hectic week to jump on this panel. So I think, should we open it up to Q&A in terms of, I'm sure people are probably interested in asking questions. I'll turn it back to Saima and see if you guys are interested in taking questions for us.
Yes, sure, Faisal. We have some questions from our cohorts first, the Lahore and the Quetta cohort. So Ithaca will add them to the panel and they'll ask questions. Then I'll follow up some questions from Facebook for both of you also. Ithaca, sure. Can we have the first person in?
Thank you, Salma. Yes, the first person from Lahore cohort is Khalid, the Intelligent Drug Dispensary. Khalid, we would like you to just describe in a shorter way about your startup and then continue with your question.
Right. Thank you, Edika. Am I audible?
Yes, you are. Please.
Right. Great. So basically, I'm Dr. Khalid Arfan. I'm the founder of Intelligent Drug Dispensary. We offer a platform as a service to doctors, patients, and pharmacies. We integrate their data together to create value for each one of the players, and then we apply AI and ML on it to offer analytics and forecasts for clients in the pharmaceutical industry. So my first question is basically for both of you, and you touched upon it briefly, I believe. Harvard Business Review suggests that venture capitalist firms in the US expect close to 25 to 35% return on their investment annually from the seed investments in the startups. So are the VCs keeping similar expectations from ventures in Pakistan? And if you could please add one more thing on this, that in an emerging economy like that of Pakistan, how is inflation diligently taken into account? What are the key sources that you trust the most and reliable to forecast inflation?
Sure. Ali, you want to take this or you want me to take it?
Go ahead, Faisal.
Okay. So in terms of, I'll jump straight to the growth rate component. I think you were asking something to the effect of how do we expect 25 to 35% from startups, and we're promising the same to our investors. Well, our investors actually expect even higher. I mean, generally they want us to, the first question is always like, are you going to 10x your portfolio, right? But really it's the growth pattern. It comes down to the adoption rate. If you are a tech platform, then ideally your adoption rate, if the use case and product market fit is, the timing is right for the market, you should start to see those month-on-month growth rates that high. Because it's really once adoption kicks in, whether you look at any of these, I mean, I'll give you an example of the new social media platform, Ali, which was, I always forget, Clubhouse.
Clubhouse,
right? So in 9 months, Clubhouse had this massive adoption. I think like literally went from zero to like $1 billion valuation in 9 months, where Andreessen Horowitz came in, wrote a check, and they were just adding users one after the other, right? So it comes down to the product. And I've seen this, in different markets where when the product's timing is correct, that is the key component, where the offering matches. So for example, if you're going to launch a fintech product, right? I think now is probably a better time. If you tried to launch this product about 3 years ago, you would have probably not seen adoption at that same rate. So these are just certain things to consider in how we expect for these things to play out. And that's what we're looking for ideally. Is the timing for your product, is it correct with the market fit as of today? Like I'll give you an example of Edtech. I did an Edtech investment. In Edtech, one of the biggest impediments, because it requires a screen effectively. So there's about 44 million school-going children in Pakistan, but of which about 22 million are private schools, low-cost private schools, and only 1 million go to high-cost private schools. And then when we extrapolated out access to screens, it was effectively just 1 million roughly students out of 44 million that had any meaningful access to a screen. And you're not going to be learning too much on your dad's smartphone. You do need a tablet or something to that effect. And so in that scenario, if you're launching an EdTech platform, that means your total addressable market is restricted to that million, right? So now I think you're going to see a lot of EdTech platforms start to scale where you're seeing microfinance lending come in. So similar to what happened in India for Baiju, where you had tablets, and then tablets had to also have financing, right? Because a lot of the low-cost private schools couldn't necessarily, the families going there couldn't necessarily afford a 20,000 rupee tablet or 30,000 rupee. They can afford 200-300 rupees added up to the school bill. So things like that, metrics like that are key for your timing. I forgot the second part of your question. I think you had it was a two-part question.
So the second part was dealing with due diligence with regards to inflation. So how, what are the key factors that you look into to assess inflation? Like, how do you forecast inflation?
So I mean, and I'll let Ali answer this too, but I go by the official government figure, right? But we take into account devaluation. So for example, in our models, we've extrapolated and created these tables all the way out to 2030. If you look at Pakistan historically, we've had on average about 5% a year devaluation from against the dollar. And then inflation comes and goes based on your rate cycle, whether interest rates are being raised by the state bank and whether they're being lowered. So given that we just went through a high interest rate environment, we're in rates, I think, are at least flat for the next few years. So, you're just extrapolating ultimately, right? And we're investing, the thing is in dollars is that as we're investing, if we don't beat inflation, I mean, our IRRs are already like double, triple of inflation usually. So that we're giving to our investors, right? So usually it's not as much of a concern, but we do, plug that in and see like, what the rupee is going to be like. Let's say it's 200 rupees to a dollar, let's say 24, 36 months. I would warn that it's highly speculative in this environment now, because we are at the tail end of a long-term credit cycle, and historical rate exchanges have become more volatile, right? As we saw from 2017 to 20. So it's nothing more than just an extrapolation and a projection. I don't know if that actually plays out the same way, where the dollar just keeps on pummeling all the currencies, or we see something else. Ali, I'll turn it back to you.
I think that covers it.
Okay. I think Saima will.
Right, so I'm gonna move on to. I'm sorry. So I had another one for you guys. So most venture capitalists prefer investing in a startup during its adolescent stage and seek an exit before the company reaches a plateau on its financial lifecycle curve. Does the same strategy resonate with what your firms have to offer? And if the answer is yes to this, then would you please expand on your criteria to establish an early stage from an adolescent startup? And in addition to that, would you also shed some light on whether you preferred private equity secondary market, share buyback, or initial public offering as your preferred exit strategy?
I don't know if I got the entire question, but Ali, maybe if you understood it, I'll let you take.
So the question is, what stage do VCs prefer to invest in, and then what are some of the, exit considerations? Is that?
Yeah. What are your preferred exit strategies from a certain company?
Sure. So typically, I think you need to sort of understand. So you will have seed Series A investors, which, Pakistan is an early ecosystem. So most of the startups are in that space, and then as some of those startups get funded, you will then have Series B and then growth stage capital. So for each stage, you will have different set of investors that are coming in. Increasingly, you will also see, multi-stage funds, as the ecosystem evolves. Some of the early funds that have been raised today may also do, growth funds and service, the startup funding needs over multiple, rounds of funding. But in the early stages, right, you're sort of, if you are in the process of finding your product market fit and you're already launched, that would be, and this is a big generalization, but that would typically be your seed stage, right? And where you have found that product market fit, and now you're looking to, validate that further and then grow maybe further, then you're moving towards, your pre-A Series A, right? And then based on that,
right,
then Series B and beyond will be catered towards growth. Maybe later parts of the rounds will be catered towards profitability, right? And then that's now changing, where the conversations around profitability are maybe coming earlier on, at least the path to it. Right. So, and then the second part of your question, which is on the exit side. So typically what happens is, right, if we are, for example, a 10-year fund, so we will have a investing period, and then we will have a period in which we have to exit through our entire portfolio, right? So typically, if it's a 10-year fund, you will see average holding periods, in some cases 10 years, in some cases the investments that you're making towards the end of your investment period, you may hold them for 5 to 7 years. And in that now cycle, you will have different opportunities, right? There may be a larger investor that wants to buy your stake, so you can exit in the secondaries. Or in some cases, if you think growth, there's a lot more growth that will happen towards later rounds, then you may hold on and exit through if the company IPOs or if it's a strategic acquisition through another player, etc.
Right. So I'm going to move to my last question, which is actually for Faisal. So I was just going through your portfolio and I found that LIVC's portfolio gives this perception of a somewhat inclination towards e-commerce, Edtech perhaps being an exception there. So it was just making me wonder whether this incline reflects a focus towards a specific industry, perhaps.
No, so a lot of the strategy is fluid, just like the market is fluid, right? So as Ali was defining before, we're ultimately portfolio managers, right? So portfolio construction is extremely important. So when I look at the market, you'll see bubbles forming in just like the stock market, right? You see bubbles forming in different segments. I shouldn't use the word bubble; it's more valuation, right? So what the strategy, when I studied the market, what I felt was that after the rise, the market was relatively fragmented, at least in e-commerce, right? And there were a lot of mobility plays happening at that time. It was just generally the hotter topic on the planet. This was in 2019 primarily. So that wave, I felt the first wave obviously is always e-commerce. I don't think that'll be the case in 3-4 years from now, right? Where most of the value would have been extracted out of the ecosystem. So that we felt that, okay, you've got Daraz that's already Ali was acquired. And I'm kind of sharing my playbook here, but I think it's important for you guys to understand because that playbook has now become old, so I can't share it. But effectively, there's Daraz that is owned by Alibaba's, and again, this comes from the exit in the mind, right? So then, when you look at it regionally, you're like, okay, there's Noon.com backed by Mar, that's growing in the MENA region, but they also are looking to enter places like Pakistan. Amazon at some point is going to want to look to enter as well. JD.com, which is Tencent, is going to want to look to enter, and then Rakuten is also looking at within their domain of what they like to acquire, whether it's your buy now, pay later, or payment space. You basically look at who's acquiring what, and e-commerce was the low-hanging fruit, you can say. So in that, it was just to kind of identify, okay, there's somebody that's a leader in one vertical, and the competition is relatively low, so let's go in there, right? Ultimately, it's just like any other business, right? So when you write a check to a company, we also look at what the competitors are in the market and how is the startup we're going to back, is it going to continue to become the market leader or continue to be the market leader? Because that's ultimately what the exit is based on. So that's what the portfolio, I think, organically just developed that way. And when I say that in the sense that those were the deals that we felt were worthy at that stage point in time. We'll see how it goes. I mean, I think this might be the fintech portion of the market that we're entering, but only time will tell. We'll see.
Well, thank you, Ali, and thank you, Faisal, for this insightful session and for addressing our questions. And I really hope to run into you guys in the future as well. Over to you, Sam.
Thank you so much, Khalid. Itika, can we have Sana for the next question?
Assalamu alaikum. Am I audible?
Ji, Sana. Hello.
I'm Sana. I'm the founder of Resource. We are an environmental consultancy that works with industries and organizations for waste reduction at source. We analyze, categorize, and quantify waste to identify reduction streams. And then we work closely with companies to first set reduction goals, and then we help them achieve those, which not only reduces their carbon footprint, but also saves them money. So my question was, what is the potential of securing initial funding for a for-profit environmental consultancy in Pakistan, which aims to initially target waste reduction and later on expand and tackle various environmental issues pertaining to Pakistan? However, return on investment will be quite low, but the environmental impact will be much higher.
Ali, you want me to take this one?
I think so again, it's a question of, what kind of investor is fit for your business, right? And I think we had discussed, what the return expectations for venture funds are and what the growth expectations are. So just, understanding that and where you fit, there may be different sets of investors that, may be more suited.
I can add, so I echo, Ali's saying, from a venture capital fund, it probably would not make sense. But if you look at it regionally, one of the biggest pushes this decade is the ESG component. So a lot of family offices, a lot of corporates are actually looking to, have an impact on the environment, right? So it's actually part of their mandate and their in terms of their long-term outlook. So my advice would be to look for funding is to actually approach those type of funds that actually are focused on environmental impact. There's a lot of impact family offices and funds that I would reach out to. In Pakistan, as of now, I think most of the funds are for profit in terms of actually like investing in companies that with an exit in mind. Over here, an exit would be difficult for us to foresee. So I think that would be the reason why I'd recommend that.
Thank you.
Faisal, also, what is a good way for Ithaca? Just a moment. What's a good way for these startups to start searching for different ventures that are interested in different areas? What are the key information sources that they can use?
So, Magnet in the region is one of those that aggregates as a listing of venture capital funds. With like everything, I would start off with Googling, right? So simple Google search on venture capital funds in Pakistan or investors in Pakistan will invariably show you the funds that are active in Pakistan. Disrupt, the 0 to 1 Disrupt, which is a conference that happens every year. We all tend to kind of converge there. So you can actually pick up, go to their website and see who's attended in the past. You can see interest from there. And then just follow like the headlines that you're seeing, right? So whether it's on, I think some of the other ones that are active in this space are Mina Bytes, even though they're UAE based, Mina based, but they also cover a lot of Pakistani funds. So it's just a simple Google search will effectively identify that. And then ask around at the NICs. A lot of people that have been active in the ecosystem for a while know this stuff inside out.
Okay, thank you so much, Faisal. We have next Hamza from Replast from the Lahore cohort. Hamza?
Yeah. So basically, Replast. So I am the founding partner at Replast, which is Pakistan's first sustainable design studio, handcrafting high-end interior design products made from Saper, which is our trademark material, which is 100% recycled and 100% recyclable plastic composite. And my question basically is, what are some non-financial benefits that you get from securing pre-seed or seed funding from a foreign investor, especially after UAE normalized its ties with Israel and is seeing a boom in its startup ecosystem? And the second part is, what is the most common pitfall when dealing with foreign investors, especially in a pre-seed stage?
Ali, I guess I'll go first on this. So look, for especially pre-seed funding, most of the international investors will require you to have a local venture capital lead on board. Ali and I are actually looking at a couple of deals like that as we speak, where effectively they've gotten commitments from international investors, but they're looking for local investors to come and validate the term sheet. So it's important to talk to both. I think if I was in your shoes, I would reach out to international VCs because sometimes your idea can be very strong and you could potentially get interest, and that sometimes galvanizes the rest of us as well. If we see there's interest from abroad, then it shows a a likelihood that there'll be more funding opportunities in the future. But it really just comes down from idea to idea, to deal. And in terms of your UAE question, I mean, look, the world is becoming. The way I would say is that this is what Ali and I were saying earlier. You're effectively going to see more and more funding coming in. The next 11, which is what Pakistan is a part of, or the next billion users, effectively, this is where all the future growth is coming. So what you're seeing is value around you has been extracted in terms of venture capital, venture valuations or startup valuations. So now money is looking for new places where the next Indonesia is, or the next India or China are. And at least Ali and I believe that this is potentially the next Indonesia or India. And so funding is going to come in. The main reason why MENA is looking ahead of us in terms of funding is because I mentioned earlier, they launched their 3G and 4G 5 years ahead of us, right? So the number of active users were higher. And so therefore, that 5-year lag effect exists. Pakistan launched it in 14, 15. So we have a greater number of users after 5 years. Ali, would you like to add something to this?
So in terms of, I think the other part of your question was, other than, if you raise capital, what benefits you get other than the capital? So, and that's where different set of investors, and VCs bring in different, value proposition. So in that case, I think you can see, again, past investments and how they played out. So those VCs will have experience in those sectors, while recognizing that Pakistan, is evolving. All the funds here are new. So within those also you have funds with different, benefits that they can bring on other than the investment. In our case, on the local side, we have, a large pool of corporates, which is similar to Lakson, and really helping on the ground in supporting you, whether it's business development, whether it's regulations, whether it's hiring. So all those things can be VCs can add value in. And in addition to that, there is in our case, we also have a partner that's been active in China and Southeast Asia. That brings in the regional and global experience that we can add value with.
Thank you, Ali. So next we have another startup from NIC Quetta, Ariba, Ek Kadam.
Assalamu alaikum.
Walaikum salam.
My name is Ariba Hassan and I'm from Ekadam. My startup name is Ekadam. So basically we sell different brands of shoes under a single roof. So my question is about debt financing and investment. How do they differ?
So venture capital is typically taking an equity stake. So we're investing for shares in your company. Whereas debt financing will give you money, and then there's some sort of a compounding rate on it, which is not necessarily paid immediately. It could be paid in kind. So for example, if you borrow, let's say $100,000, and there's a 10% compounding yield on it. And it's a 2-year term. So effectively after 2 years, you'll have to pay it back. And sometimes the debt financing can delay the conversion into equity in a company or stocks in a company. So it just depends. Venture capital funds do both. Then there's a whole separate class called venture debt, but that typically doesn't come into play, I would say, till much later in the company life cycle. That typically comes into play at Series B, Series C. But that's my 2 cents on it. Ali, your thoughts on the dichotomy?
Sorry, I lost the last bit of it.
No, I was saying, any thoughts you have on the dichotomy of venture debt versus venture capital?
Yeah, so very simplistically, I think, so on early stage, you would have, venture debt that, converts into equity. There may be, in some cases, coupon rates, but on a fundamental, early ecosystem, mostly we've seen, convertible debt, and equity, which is, simple equity where you're acquiring a certain percentage of the company. But we haven't seen too much around, other structures of debt here right now.
So it's a relatively early market.
Thank you. I have another question that does the geographical area matters in the investment?
When you say geographical area, do you mean your location of the venture of the startup, or
Yes.
your addressable market? Yeah, I mean it makes a difference because ideally, if it's a Pakistan-focused fund, they will look for you to capture the target market in Pakistan, but then your capital also is limited to those funds that can invest in Pakistan. So if you're going to another location geography, let's say like in Middle East and North Africa, you may have access to larger pools of capital. But it really comes down to your own expertise, because ultimately the capital is going to back you based on your conviction and execution ability of the idea, right? How well you know the target market. So I think it does make a difference.
I think Faisal, maybe Ariba also wants to know whether within Pakistan, another city, let's say she's representing the Quetta cohort, would that make a difference also? You've answered the international part, but maybe that's also a concern with Ariba.
Yeah, so again, it comes down to the total addressable market, right? So if it's a tech-based startup, and let's say your geography is only in Balochistan, right? We would just have to look at the amount of internet connections, active users. I think it was one of the metrics I was looking at from Kareem, where one of the top used cities was actually Quetta, after like Karachi and Lahore. So it just, these are we look at metrics, I would say, not necessarily the specific geography within Pakistan. As long as you're scaling, that means you found the right product for your geography.
Itika, do we have another question from Quetta, or should I?
Yes, we do have Brishna Ricky from Charisma Studio.
Okay, let's have Brishna.
Yeah, that's the last question.
Okay.
Assalamu alaikum.
Welcome.
Hello.
Yes, Brishna, we can hear you.
Itika, would you like to ask Brishna's question in case she has a problem with the internet?
Yeah, sure. So her question is, how do you know which investor is the right fit for your business?
So, really it comes down to this. I think we discussed this early on as well.
Yeah.
It really just comes down to the stage of your startup in the company life cycle, and then going to our websites and seeing what we've been investing in. A good barometer is always to look at the type of companies we've been investing in and what type of rounds. So I think that's important to take a look at. And then the other thing is making sure that you're comfortable with the investor, right? Because these people are going to be sitting on your board. You're going to be seeing them a lot in terms of guidance and everything. So that's also important, the human element of it. Not every investor is a fit for every company.
Faisal and Ali, I would like to ask a question for the cohorts, and that question is, how important is the business plan or your preparation of documents for at least the investors summit or finding a partner? Because we're working on these documents and many people have asked these questions on Facebook also. So can we talk about that, please? Thank you.
Yeah.
So I think for the investor summit, right, you have two components, right? One is you are presenting to the investors. And then the second component is, post the investment summit, the follow-on interest and conversations, right? So your goal in the investor summit is to have, enough information that creates a lot of interest. So not going into too much details, and highlighting if you have, if you already have traction. I think that's the best. You should, start with, hey, we're an e-commerce company and we do 1,000 orders a day, right? Something like that. Or if you've so something like that, but keep that part more crisp and to the point, and then you really get the message across on what you're trying to do. So your goal should be by the end, it should be a focused presentation that gets whatever it is that you're trying to get across to the investors. So they pick those 3-4 key points. And then the second part is, post the investor summit, you will attract interest, and then the readiness for that. For that, you need a pitch deck, which would be a bit more comprehensive, than the one you are presenting in the investor summit. And that will include, who the team is, what the product is, how you are unique in terms of your value proposition, what you've sort of learned about the market. Maybe, there's some unique advantage or unfair advantage that you have. And if you've already, sort of validated that market in terms of traction, then highlight that. And then end that by, how much capital you need, what you need it for, and the use cases of that capital. So that's how you would structure it. And then, post that, I think in the early days, you will need some form of, Excel financial model, etc. But I think investors would understand in some cases, that this is evolving and these models and assumptions are flexible and will change. But it's more to understand the mindset and then how, directionally where this is going, right? And then whether you have an understanding of those key metrics and the model. So those are some of the things, pre and post the summit that I would work on. Faisal, please add if
No, I think you very comprehensively covered all of it. I mean, I think I'll answer more from the summit point of view. It is a summit point of view and from the venture capital if you're applying to investors. Really, it comes down to your deck and your thought out stuff, right? So really, if let's say the metric that I always look for as a judge, using a lot of these panels is. Have you guys done the accurate understanding of your total addressable market? So what's the size of it, right? That's the main one. Look for your competitors and comparables in the market. So if you have an idea and if you can find companies in the region, similar markets, whether it's India or Middle East and North Africa or Southeast Asia, that's always helpful. And then your local competitors, that type of analysis is good. So financials are important, but I would say less so if you're really, really early stage, because it's just going to be assumptions, and that's something you can always do. But I would try to have at least some baseline understanding of the financials to show the judges that you actually at least understand, you have the skill set to actually be able to execute and think through your project. So I think that's the only thing I'd like to add in terms of what you should be looking for.
Ali and Faisal, is it okay if I take a couple of questions from Facebook? Do we have time, or are we tight of time?
Yeah, I think I can probably do 10 more minutes. Ali, how's your schedule?
Yeah, I'm good.
So there's a question that says that how can startups be more secure when they share their business model with a potential investor, without knowing end part that whether they will be secure investment or not. Startups are investing their time out of their businesses to pitch investors and still insecure. So I think she just wants to know whether it's okay to share your business model with someone without the guarantee that you'll get the investor.
So me personally, I think if your idea is really good, you shouldn't be worried about it getting stolen. You should just be confident and go out there and invest. I mean, the same thing would happen to most of us when we're raising our funds for our venture capital funds. If you share your investment deck and your details, I mean, if you're going to be worried about someone getting a hold of it and copying it, I think you should be confident in that idea. There's ways to secure it. I mean, you can sign non-disclosure agreements, but they're really not that enforceable. So approach institutional funds and serious investors. We're not in the business of copying ideas. We're in the business of accelerating and investing in ideas. So I would differentiate between proper funds and investors and other type of investors. But generally, I think we should take the fear element out. And if you believe in your idea and you're confident in yourself, you'll be able to execute it. Financials, maybe you can hold off in sharing, send out a teaser, then send out if there's interest, then send out a more detailed deck, and then send out the financials if you feel the interest level is there.
But I think also in terms of, if I understand the question, is whether, once you're sharing information and if you have commitment from the investors, that will materialize. I think that's not the case. Typically, you will have to, meet a lot of investors. And then that's the same case for VCs, where you have to meet a lot of investors and you will hear both yeses and nos, but you have to, keep at it, be persistent in your approach, and eventually you will find that interest.
I have another question, which is slightly broader than just the summit or getting funding. This question is saying that besides the strength of the idea, what strengths should entrepreneurs themselves have to succeed?
So I think idea, eventually, yes, the idea is important, but then, idea, and many people will have the same idea or similar ideas, but it's the part that comes next. Typically, if you're starting a company, you will need to be day and night, 2 years, but for, at least a decade or so, right? So what's important is also then recognizing, your own strengths, and then also your weaknesses, and then thinking through, these are my strengths, this is where I can add value. Now, how do I bring in or build, strengths around me that also overcome some of those weaknesses, right? Whether that can be through co-founders, whether that can be through partnerships. So that all depends on that particular case. But idea eventually becomes, it's an important part, but not the most important. Where key assessment, and then that's what we think about is, two people have the same idea. Which one do we think can execute better and is better positioned in their execution process?
Faisal and Ali, leaving thoughts for people who want to come into the venture capital area themselves. Any leaving thoughts for those people aspiring to do this?
I would encourage people. I think this decade, especially given the pace of adoption of technology, a lot of your traditional jobs may not be the same in 10 years from now. So I think that if you truly have an idea and you feel like you're set, you have the entrepreneurial instinct, I would, or you can partner with someone that is an entrepreneur and you can become a co-founder or join a team, provided that it's something that interests you. I would definitely encourage people, because I do think there's going to be a lot of funding coming in. Everyone's interested in Pakistan. A lot of the international investors are expecting Pakistan to be the next big market in South Asia, and I would say in Southeast Asia even. So lots of room for growth, and I think the traditional mindset won't work in this decade, as we've officially entered the information age, and a lot of job disruption is going to come by 2030 in the form of artificial intelligence and anything that's logic based. I think algorithms will be able to tackle very easily, whether it's accounting or legal stuff or even your basic level of OPD, just basic diagnosis at a hospital. So just something to think about from a long-term thinking perspective, and not just venture capital. I would say that just think a little bit more outside the box, because it's going to be required in the skill set. I think, in my view, the last time we went through this was the migration of the agrarian age to the industrial age, where a lot of people suddenly found themselves with a skill set that had no use until they retooled. I think that may happen a lot quicker in this decade in life cycle. So should just think outside the box.
I think in terms of, if you're also starting out, today, we were looking at, multiple different ecosystems and their evolution, in similar comparable countries. And what we found is, you had, in the internet age, you had the internet 1.0 that moved to 2.0, and advanced economies are now maybe at 4.0. And what we're seeing in Pakistan is the difference, the timing difference between 1.0, 2.0, 3.0 happening sooner. What that means is, models seeing from other markets, being able to see, okay, I started off in the mobility business, can I also become a wallet, or can I go into, other multiple verticals, right? So they've already seen that happen. And so they're jumping to the next evolution of their business faster. So if you're starting out a company today, I think understanding, how different ecosystems have evolved and how Pakistan can evolve, right? Both from an investor perspective and starting a new company perspective, I think that could give you good insight. I think this is something Faisal also talked about earlier, which was, the importance of timing. So 5 years ago, if you're starting a fintech company, right, or even, other e-commerce on-demand companies, you only had 20 million internet users, right? So, and then a subset of that would be addressable. And today you have, in the next year or so, maybe you'll cross 100 million users. Then you have the right policy infrastructure that's coming in today, a few years ago that may have not existed, right? So seeing where the opportunities are in terms of how the ecosystem is evolving can give you good insights on the opportunity.
Okay, thank you very much, Ali and Faisal. I can't say from NIC, because both of you are NIC, and I think our conversation came very much in time with what's happening at the present cohort as they prepare for the Investors Summit. And today we've also officially opened the applications for the next cohort. And I hope listening to your conversations, more startups are encouraged to apply at NICL. Thank you very much, and I hope to engage both of you more as we take NICL forward. Thanks a lot, Faisal and Ali. I think it was a very interesting and engaging conversation, and very open to all kinds of questions that our cohorts had.
Sure. Thank you so much for having us.
Thank you for having us, and look forward to meeting everyone at the Investor Summit and the new cohort.
Yeah, we are also very excited about it, Ali.
Yeah.
Thank you, both of you.
Thank you.